TD Economics has come out with their quarterly forecast, and you've got some pretty interesting things embedded within it, I might say. You take a look at the world, and then of course the United States and Canada. Let's start with the world, and the one thing that you highlight is everything seems to be in sync right now.
This is right. It's probably the most optimistic I've been as an economist in about 8 years.
Which says something.
It does. It does. It shows that we finally have hit a little bit of a synchronicity in terms of growth amongst advanced economies, simultaneously with growth amongst emerging markets. And within that mix, Canada is one of the outperformers in the mix, but also the Eurozone, which has struggled quite a bit. 2012, 2014 was finally showing a nice growth impulse coming from household spending, business credit, business confidence. So everything seems to be, in spite of all the geopolitical risks, everything is moving in line.
Which is so interesting just for that last reason, because if you read the headlines, I mean, you know, the sky's falling, and then if you take a look at the economics of it, again, I've never seen, you know, an economist so optimistic before.
Yeah, it's always watch what they do, not what they say, is the adage. And I think if you look at things like trade flows are moving at a rate of about 6% year-over-year growth. If you were to go back a year, they would be negligible, about 1%. And that speaks to this synchronicity of growth where, you know, it's this notion of a rising tide lifts all boats. And so everybody's increased activity is feeding off of everybody's increased activity. And one of the more interesting aspects is it's not just related to, for example, a lot of people will attribute growth in Canada to the housing market. When you look globally, it's quite a diffusion of different factors. So it's not a single driver such as housing that's pushing up the Eurozone and the US and Canada and other countries. It varies by country, and that's good because it means that you can't just have one thing weaken and all of a sudden the legs get kicked out of the recovery.
I guess that maybe the exception would be that maybe interest rates. I mean, if interest rates were to go up quickly, which I don't think they're going to, I mean, no one's predicting, but that would certainly change things.
Yeah, they are going up, obviously, in the US, which has already raised 4 times. The Bank of Canada is trying to prime the markets as well for a rate hike. They're not going to be going up anytime soon in the Eurozone. The Bank of England, Mark Carney, has indicated a reservation to increase interest rates as well. So it's sporadic. The trend is definitely towards less monetary stimulus than what we've seen in the past, so that should lift bond yields in general, but nothing in terms of a rapid or harsh move.
You said one thing just a moment ago, too, that I want to go back to. You said that Canada is actually leading the way in growth. Pardon me?
Yeah, exactly. I think a lot of Canadians don't realize this themselves, that the fastest growing economy in the last 9 months has been Canada relative to the G7 economies, well over its running speed, which is estimated to be less than 2%, and we're sitting at about 3.5%. And so this is why you've heard some of the change in the tone from the Bank of Canada, that if we're running that much higher than our potential, our running speed, you are continually eating up slack, and eventually you get to the point where it gets really hard to justify maintaining emergency level interest rates at 50 basis points for the overnight rate. So we are increasingly hearing the tone starting to shift at the Bank of Canada.
We'll come back to Bank of Canada and just sticking with the global outlook right now. You've got an interesting chart here that I want to bring up, and it talks about the ripple effect of a slowdown in China. This has a couple of lines on this chart. One is showing, I think, imports from major Asian trade partners to China, I'm assuming, and then China's credit impulse. What is this showing us?
Basically, it's showing that the lending activity in China amongst households and businesses is slowing. This is in part orchestrated by the Chinese authorities, where they're trying to get more balanced growth and move away from some of the risks of a very credit-fueled economy. So it's good in the sense that they're orchestrating this slowdown. Their economy is probably going to be running at about 6% pace in the next couple of years, which is, you know, not so bad compared to what we've seen in the past, which is closer to 7%. The knock-on effects to trading partners is that if they're slowing down, countries like South Korea and Taiwan that really rely on them from their export market will likely feel those impacts. So one of the more interesting developments out of emerging markets is that advanced economies are having this acceleration in growth, and emerging markets are participating in it, but they actually trade more with each other emerging markets than they do with advanced economies. And so it's the growth prospects of China and emerging markets that matters to that bloc more so than what you're seeing out of the advanced economies. And that wasn't always the case. They used to send more than 50% of their exports to advanced economies if you go back to 2000, but that's at about 35% now.
And that could even change anymore given some trade policies,
That's
but
right,
that's a whole different ball of wax. You highlight some other global risks out there as well. So you could see a change in China, but again, not impacting the advanced economies like you said. But what else is out there? Because some risks, like the French election, turned out to not be a risk.
Yeah, that was a safe landing on that side. But we haven't completely averted the risks of populist governments coming into play. Italy has elections coming up next year. There's a turn in sentiment occurring within that nation. There's Hungary as well, and Czech also going through elections next year. Eastern European countries also at risk of populist governments. And the reason they're relevant is right now they have, as Eastern European countries, they have refused to take in migrants from the Europe region. And there is a challenge being placed on the European Union that they need to take migrants in as part of the condition of this free trade of goods and everything, all the other benefits that you get. So there's still tensions happening inside of Europe, even though we've had some positive outcomes like the French elections. And then, of course, trade wars. Trade wars seem to be always on the horizon now, especially with the US government making it really a key pillar of something they're following through on their campaign promises.
One thing that you talked about, in terms of the campaign promises and just what's happening in Washington, you've got a chart here that talks about what the turmoil we're seeing in Washington versus what's actually going on in the economy, which goes back to that point talking about the fact that actually the economy is doing pretty well. Thank you very much.
Right, so the US is at a cruising speed at about 2.5%, and that's in spite of the fact that you see indices that show you global policy uncertainty at extremely high levels. And these global policy uncertainty indices, they usually pick up chatter in the media in terms of risks and certain code words that signal a rise in uncertainty. But you're not seeing it reflected in the VIX and market indicators. And certainly you're not seeing it reflected in terms of consumer behavior or the speed of the economies. When we looked at incidences like under President Clinton and President Nixon, when you had very tumultuous times in presidential periods that were similar to what we're seeing out of the current Capitol Hill, a movement towards more angst, and in those particular cases with those two presidents, towards an impeachment process. You actually didn't see economic links very closely tied to what was happening. At the end of the day, it was what's happening on the ground as opposed to what's happening at, on the Hill. And you had a number of things happening during Clinton, for example. You had long-term capital management, you had Russian debt default, Asian flu. Those are the events that dominated the markets. And in the case of Nixon, it was what was now deemed to be a policy error of the Federal Reserve of over-tightening that led the economy into recession before you were going through impeachment processes on that front as well. So these are the areas that, even though we have a lot of noise coming out of Washington, really, it's the policies on the ground that matter the most and how they affect sentiment.
Okay, let's focus a bit on just the states because it matters to us, and then we'll go to Canada. But in terms of the policies themselves, President Trump and his team have talked about 3% growth being what is needed, and you highlight the fact that no, not going to happen.
Not likely, no. You would have to have some really dramatic changes. So if you just think of how the math of an economy adds up, there's two basic components, and it's basically how many people do you have working for you? So your labor force growth, and what are they doing in terms of output, so your productivity. Your labor force growth is just continually trending down in terms of aging demographics in the US, and that's a natural force that's in play. Only thing that can really change that is a very substantial move in immigration policy, which
probably not going to happen.
Nope, does not look like it's going to happen. So as you take out those long-term projections, labor force growth is only going to grow by about 0.5 percentage point, and half of that is coming from current immigration flows. So if you have a change in policy there, you're really going to take that number down, which means just to get to 2% growth, you need productivity to run at about 1.5%, which is double the pace we've already seen. So it's very hard to get the math to add up to 3%. You need a really big influx in labor force or even more extraordinary gains in productivity. So very big gap to go from 2% to 3%.
At the same time, you've got a chart here that shows, it's interesting, because I don't think people might know this, about the trends in corporate tax rates. Bring this back to what we were just talking about in terms of maybe what you see happening and maybe what that could mean, though, because if you lessen taxes, I'm assuming it's a little less money again that they have.
Yeah, so the challenge is trying to balance off these campaign promises. with the restraints that they have in the economy. When it comes to corporate tax policy, the U.S. has a fairly good leg to stand on that. Right now, they do have relatively uncompetitive corporate tax rates. We've seen them fall amongst major economies over the last decade, but they haven't in the U.S. There's a lot of inertia there. And that's true if whether you look at a posted tax rate, an average tax rate, or a marginal effective tax rate. They're all higher in the U.S. relative to many of its peers. So while I don't think it's realistic we're going to get massive tax reform happening in the U.S., I do think it's realistic that they will try to follow through with tax cuts to the corporate sector because there's been so much inertia for so long, and it's really starting to gap even more with other countries. So there's a good leg to stand on there.
I want to put this one chart up because you wouldn't be an economist if you were rosy all the time. So this is something you've got here about policy normalization, talking about what's happening with the Fed fund rates. What are we looking at here?
This basically shows that if the Federal Reserve continues to increase interest rates, even at what they're predicting, it was about 3 hikes per year. As you approach 2019 and early 2020, you are getting inside the window where those rates start to meet up with what we would say is the long-term equilibrium rate of the economy, which is consistent with stable growth. When you push past that level, that's that R star in the graph, when you push past that level, it's not long afterwards that you see a recession follow because you've had a policy mistake. You've over-tightened relative to what the economy can sustain. And so a lot of folks who do business cycle analysis will look at this measure to predict that the next recession, the most likely period where you're at risk of that, starts to come inside of scope at 2019, 2020. And you could also look at things like unemployment rates and how much more room they have to go down given that they're already so low would be another metric that folks refer to. So those are your little red flags that we watch for, and it's one of the reasons we think that the Federal Reserve will become more cautious in the rate cycle as they go beyond 2017 and 2018 because they're going to be aware of the same dynamics that we're looking at.
Let's finish off with Canada, and again, you showed us that lovely chart earlier on in terms of showing Canada outgrowing its peers right now. Where is it coming from? Where's that growth coming from?
Yeah, so a lot of it has been coming from the housing market, and Ontario and BC have been to credit for that. But more recently, we've seen it broaden out. So investment has become a bigger contributor, and one of the key areas of growth has been energy. And again, one of these surprising elements about Canada is that we had huge contractions in an energy investment in the last 2 years. Single-handedly, we're shaving 1 full percentage point off of growth every year for the last 2 years, and that's now flipped into the positive camp, and it's contributing to growth. So that's good with the stabilization of energy prices, but also as companies have learned to become more efficient and projects are now coming back online, so that's good. And we're also seeing in a number of other areas, we're seeing capacity pressures build in sectors that are very domestically oriented, food, furniture, chemicals, and these are areas that are starting to contribute to the economy as well.
So bottom line, Bank of Canada, as you mentioned, has a little more room now to do what they think they need to do. What's your outlook for the Canadian economy over the next couple of years?
Yeah, so this year is looking very good. It's mostly in the bag. We've had a couple of good quarters of strength. Momentum in the second quarter looks good. So we're looking at another year where we're going to be about 2.8%, which is fantastic for Canada. We don't think that momentum will necessarily hold because we do need this rotation of drivers away from the housing sector, but it gives the Bank of Canada more than sufficient foundation to start taking interest rates off of those emergency levels. So we do think the first hike will come as early as October and probably 2 more hikes next year in 6-month intervals. So very gradual, slow normalization of policy, but one probably that they're getting ready to do liftoff basically.
Beata, thank you very much. Great to talk to you as always.
My pleasure.